A few weeks ago, Coca-Cola announced that it would have to pay $6 billion in back taxes and interest to the IRS after a US tax court ruling. Now, the issue is a very complex yet interesting field of taxation called transfer pricing. Now, I'd like to discuss what transfer pricing actually is, what happened with Coca-Cola, how it happened, and how the entire litigation process could have been avoided in the first place. Now, Coca-Cola said that they are going to appeal and defend the company's position vigorously, so I'd like to hear your thoughts in the comment section under this video. Before we actually get to the court case between Coca-Cola and the IRS, let's talk about what transfer pricing actually is. So let's assume for a moment that you are a business owner and you run a company called Parent A that's located in a country with a very unique name of A that has a 25% corporate income tax rate. So this Parent A, you manufacture a product that costs, let's say, $200 to manufacture. And so you want to sell this product to a different country, but in order to do so, you first have to sell this product to an affiliate of yours, and this affiliate will name B, that's conveniently located in a country with the name B that has a 45% income tax rate. So let's say you have a choice of selling this product to your affiliate with a selling price of either $250 or $600. Remember, it costs $200 to manufacture. As a business owner, what do you think is the most beneficial selling price that you can charge to your affiliate, and then your affiliate sells your product to various retailers or end consumers in this other country? What selling price do you think you should be charging your affiliate? And you can pause the video if you want to think about this, but for the sake of time, I'll tell you that because country A has a lower tax rate, it is beneficial and, if possible, to make most of the earnings, if not all of the earnings, be earned in country A. So we want to generate higher revenues in the country that has a lower tax rate. And in the country that has a higher tax rate, we, on the contrary, want to increase costs. So with this reasoning, it is more beneficial, obviously, to charge $600, because this way you will have higher revenues in country A that doesn't have a high tax rate, and you will have higher costs to offset any income that your affiliate B happens to produce, because you want to have costs high because the tax rate in this country is so much higher. So I hope that makes sense. This is a very simplistic way of viewing what transfer pricing is, but I hope it makes sense. By the way, when it comes to transfer pricing, it wouldn't affect the consolidated and total income of the company, because when you produce the consolidated financial statements, you have to eliminate all the intercompany transactions. So the grand total income of the company will not be affected by transfer pricing arrangements. What is affected by transfer pricing is the tax liability and effective tax rate. It's very complex and there are a lot of nuances, and I'm not going to bother you or bore you to death with these regulations. I'll only touch briefly on what the essence of transfer pricing is. So both the IRS and OECD basically have guidelines on how to determine the right pricing that you can charge your affiliates for your goods, services, and so on and so forth. And the main concept of all these methodologies on determining the right price deals with the concept of arm's length transactions. What is arm's length? That basically means, what would you have charged for your goods and services had this business not been your affiliate? Basically, had you been dealing with an unrelated party, how much would you charge? You should charge the same thing from your affiliate. It's easier said than done because again, different businesses charge different amounts from unrelated businesses, so it's hard to say exactly how much. So there are numerous different methodologies on figuring out what is arm's length transaction. I will not discuss all the methodologies because there are a lot of them and there is no point, that are separated into two main categories. So the first category being transactional methods, and the second category would be profit-based methods. Profit-based methods usually tend to be more reliable and more widely used. So when it comes to Coca-Cola, unfortunately, I don't know what kind of methodology they have been using. They didn't disclose it in their financial statements, but they did disclose a good amount of background information on where it started and what happened. So let's take a look at this because it's actually very interesting. It was a dark and stormy night on September 17th, 2015, when Coca-Cola received a notice from the IRS saying that the administration has made an adjustment to their transfer pricing for the years 2007, 2008, and 2009, and the result is that Coca-Cola now owes them $3.3 billion plus interest, I assume. So we're right now in August 2024, so interest accrues, and therefore now they have to pay $6 billion. Apparently, from the notes to the financial statements, a similar transfer pricing issue happened with Coca-Cola, where the IRS audited them for the years 1987 through 1995, and in 1996 the IRS and Coca-Cola agreed on a specific arm's length methodology. They don't say which methodology for sure. I guess it's none of our business to know, but they agreed on a specific methodology where the IRS said, okay, Coca-Cola, unless something significantly changes, you can use the same methodology and we will not be challenging this position anymore. The IRS audited and confirmed the company's compliance with the agreed upon closing agreement methodology in 5 successive audit cycles for tax years 1996 through 2006. So for all these years, the IRS had no problems with this transfer pricing methodology that they were using, and all of a sudden for the years 2007 through 2009, the IRS says, oops, there was a problem. According to the notes, they say that we're going to litigate, we hope to win, but if we don't win, we'll have 90 days to file an appeal. But in that case, if we lose this litigation, we'll have to pay approximately $5.8 billion as of December 31st, 2023. Obviously, they missed the estimate by a little bit relatively, because right now is August 2024, so more interest has accrued. What does Coca-Cola say? They basically say, okay, so in 1996, we had this closing agreement with the IRS, where the closing agreement provided that absent a change in material facts or circumstances or relevant federal tax law, the company will not be assessed penalties by the IRS for using the agreed upon tax calculation methodology that the company and the IRS agreed would be used for the 1987 through 1995 tax years. And so Coca-Cola asserts that based on this closing agreement, we've been using the same methodology, so we don't understand why IRS is having problems with it now. So it seems like IRS has a very good position to defend itself when it comes to material changes or changes in circumstances. There are also arguments for the IRS. So let's discuss some of these next. So first of all, I found this article that you can check out. The link will be provided in the description of this video. And I don't know, unfortunately, exactly where the article derived this from. Maybe they read the actual court case, but they said that the IRS applied the comparable profits method. It falls under the profit-based methods. So you can see in this chart that this article kindly provided the average return on assets earned by food and beverage companies from 2007 to 2009. So Coca-Cola obviously makes more because it's Coca-Cola. And if you look at all these affiliates and subsidiaries, they make significantly more than Coca-Cola itself, and obviously a whole lot more than an average food company. So that's the main claim of the IRS, saying that whatever Coca-Cola was using as a method is no longer relevant, probably because the profits-based method is more reliable and it shows a crazy discrepancy. So apparently there is some income shifting going on that is not appropriate. But when it comes to income shifting, different countries obviously have different corporate income tax rate, at least statutory. As most of you probably know, as a result of TCJA, Tax Cuts and Jobs Act, the statutory corporate rate has become 21%, taking effect on January 1st, 2018. Before then, the US had a progressive tax rate on corporations. So the corporate income tax rate started at 15%. 35% was the highest tax rate for US companies. So as a result of TCJA, the US has become a lot more competitive when it comes to doing business here because tax rates are not nearly as high anymore. There are some countries that have lower tax rates. For example, Ireland has a 12.5% corporate tax rate. So when I see this in this chart that Coca-Cola is shifting a lot of its income to Ireland, it makes sense. You want to shift your earnings to a lower taxing jurisdiction. However, there are other countries that doesn't make as much sense. For example, Brazil, it has a 15% corporate income tax rate, which is lower than 21. However, it has a surtax of 10% for income exceeding a specific threshold, but the threshold is low, so I assume that Coca-Cola's affiliate exceeds this threshold, so the ultimate tax effectively is 25% in Brazil, probably. Another country is Chile. I don't know how to pronounce it, obviously, 27%. Mexico had 28% back in 2007, but right now it's 30%. Costa Rica has been having the same percentage of 30%. And Swaziland is actually a country in South Africa, and now it's called Eswatini. I don't know. That one has a 25% corporate statutory tax rate. So it seems like most of these countries right now have a higher tax rate than the US tax rate of 21%. So the question is, why would Coca-Cola shift income to all these countries instead of shifting them back to the US and paying just 21% here? So I found a few theories to potentially answer this question. The first little modest theory comes directly from the financial statement, specifically note 15. It says, as a result of employment actions and capital investments made by the company, certain tax jurisdictions provide income tax incentive grants, including Brazil, Costa Rica, Singapore, and this country in South Africa that I have no idea how to pronounce. So it's possible that the reason Coca-Cola keeps shifting these earnings to these countries is to have these grants offset the large earnings. Another theory is actually even more straightforward, I think, is that, as I've mentioned, this methodology that Coca-Cola has been using was agreed upon back in 1996. And at the time, the US corporate tax rates were a lot higher, as I specified before, and I found this chart from Bipartisan Policy Center for you to see the progression of corporate tax rates in the US. In 1996, all these countries had lower tax rates than the US, so it made sense to shift income to those countries. Obviously, TCJA came into place in 2018, and we're only talking about 2007, 8, and 9 at the time. Corporate tax rates were still up to 35%. So I guess it was beneficial for Coca-Cola to keep shifting earnings to those affiliates. And as promised in the beginning of this video, there is one thing that Coca-Cola could have done to avoid this entire malarkey in the first place, and that is called advance pricing agreement. So as you have probably implied by now, compliance when it comes to transfer pricing is incredibly challenging and expensive. So when it comes to filing tax returns with the IRS, companies have to provide an enormous amount of disclosure. They have to conduct research and calculations and determine what methodology to use and defend their position basically on an annual basis. And things like this can happen. The IRS can challenge your position and make adjustments, and if that happens, the litigation is kind of unavoidable. There are certain things that taxpayers can do to prevent this. For example, obtain private letter rulings. There are certain safe harbors for smaller businesses, but the safest thing, I wouldn't say it's the easiest or the least expensive, but I would say it's the safest thing, is to obtain an advance pricing agreement or an APA from the IRS. It's a voluntary thing that companies can do. They can obtain help from the IRS and conduct research, calculations, and be in specific discussions about what methodology to use and what range of prices would constitute as okay prices. And once you obtain this agreement from the IRS, you are basically safe from audits or from IRS challenging your position. So you don't have to be disclosing uncertain tax positions or disclose nearly as much information with your annual tax returns to the IRS when you have an APA. The downside of an APA is that it usually is not indefinite. It only covers a specific period of time that the IRS agrees to cover. It could be a few years, it could be 10 years, I don't know. And you still have to provide some disclosures. Basically, you have to say, yes, IRS, here are the disclosures, we're complying with the APA. But most importantly, it's very expensive in the beginning. When you do the APA, the studies are very in-depth studies. The research is very in-depth. There are a lot of calculations, there are a lot of back and forth, and also obtaining an APA costs, I think, about $113,000, if not more, to obtain just an initial APA agreement from the IRS. However, I would venture to say that $113,000, maybe a few $1,000s more, is cheaper than paying $6 billion as a result of this litigation and, you know, putting uncertain tax positions and reserves on your financial statements for the investors to see. And when APAs expire, you can renew them, and the renewal, I think, is about $62,000, or, you know, half of whatever the initial cost is. And please note that the closing agreement that Coca-Cola refers to in its financial statements and I guess in the litigation documents is not the same as the APA. Those are two different things. APA is voluntarily. You ask the IRS, you contact them, and you have to pay this fee, and you do it specifically to obtain this letter from the IRS. And the closing agreement was just an agreement based on an audit that the IRS did back in 1995 and so on. So these are two different things. Had Coca-Cola obtained an APA from the IRS, it would have been a completely different story. There would be no litigation. So I don't know what's going to happen with Coca-Cola. They state that they're going to defend their position vigorously and hope to win the appeal. And if they lose, will the courts require Coca-Cola to use the new methodology through 2023, 2024 going forward? So I think it's a very interesting thing to pay attention to and see how the events turn out. If you have any tax-related questions, feel free to contact me on my website at liliacpa.com. You can also find me on LinkedIn. I am a New York and Florida licensed CPA. My first consultation is free, and I hope to hear from you and to see you in the next video.